Right after finishing up last week, the really good rally to end the week, and for that matter, pretty much ending the month, we didn't really follow through with that a lot today. The end of the month, though, still is coming up by the end of the week, so we still have some time. Of course, by this weekend is a holiday weekend, so next Monday we'll have off for the July 4th market holiday. So we pretty much have the rest of this week to see how we do. There's been pretty much a tradition here this year of finishing a month, especially the end of a quarter, with a really good move to the upside. The question is, how much further will it go? So I'm going to break that down as to what resistance levels, what are the indicators looking like, how likely are we to kind of keep going, or are we hitting up against a ceiling right now? So we're going to break that down, what our expectations are. If we do hit a ceiling, how much longer are we going to be bearish? We're going to look at that. What's driving a lot of this weakness? What's driving today's moves? And then we'll take a look at a stock that kind of looks like the market, and we'll talk about how to trade it if it's hitting its own ceiling in the short term, what we can do and how we can protect against a breakout to the upside. So let's go ahead and get started. Today is Monday, June the 27th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel, like our video down below with that thumbs up icon, comment on the video, join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching this video on our blog, come down here to the bottom, click that heart. It opens up this tab. Hit that like button. Do the same with that thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to more of our followers with the more engagements and likes and shares and retweets that they have. All right, let's take a look at the S&P 500 with the market forecast indicator. And you can see we're kind of running up against some resistance. You see all these lines right here. These are all resistance levels. They're all kind of clustered here. They're all Fibonacci retracement lines based off of different periods. The black line, of course, is based off the post-COVID rally. So that's the 38% retracement of this post-COVID rally that we've been on that culminated here this year. The red line is the post-2009 low point rally. So very long term, and you can see we had finally broken both those lines at the same time back on June 13th, and then barely crossed above those lines last week on Friday there. The 23% line is this current decline we've been on since the beginning of the year, basically the market sentiment decline, now that it's pretty much almost in the lower reversal zone. And then the green line's on the current intermediate decline, the current drop that the intermediate line is on since its last peak. Over here, we don't count that one because it didn't get in the bearish or bullish territory up above the 60th, and you notice we didn't get above 2.5% above the moving average either. So we're still on this. I mean, it's a pretty long intermediate run, so you don't expect that this intermediate run will last that much longer. It's pretty. I mean, it doesn't last very long on the bearish moves. They tend to be quicker, but this has been really gradual, very, very uncommon for declines. And of course, you can see this market sentiment decline we've been on for about 6 months now is also pretty uncommon, considering that usually by now we've had some kind of washout period, which of course we haven't had yet. Regardless, you can see the intermediate line is above its market sentiment, though the market sentiment is still dropping. It's kind of flirting with the lower reversal zone. It hasn't been in the lower reversal zone for a long time. The intermediate line is still in bearish territory. It's rising. Hasn't gotten into bullish territory, so until it gets above 60, most likely that would require a break up above this 4,000 area, probably getting up above 4,100. See, once you get through these lines, which are all acting as resistance levels, and we broke through the bottom of that zone, and now we're sitting at the top of that zone. So this whole zone between the orange line and the black line kind of being one big layer of resistance, basically, that we were kind of flirting with over there, and now we finally broke through in June, and now we're kind of hitting that resistance. So you're probably going to have to, now once you get up, since you're above the black and red, you don't have another line. Those two lines are done. So if you were to get above this 38% level, then you'd be able to be really bullish. You'd be well more than 2.5% above the moving average, and you'd be able to get going. And obviously that's not the case. So you're at some pretty decent resistance. The next layer of resistance here is just over 4,000. The near-term line's up above 90, so that's very good sign. If we're going to be bullish, that's what it takes. It'd be ideal if the momentum line got up there, and that's not the case. It came really close on Friday because it closed near the high, but then but today's really small range. I mean, look how small the range is compared to average. So unbelievably small range brought the momentum line all the way back down. Not the greatest day, follow through day, right? Like you would really like to follow through a good bullish kind of almost breakout type day with another breakout, and that's just not the case. Let's take a look at the weekly chart here for the SPX, and you can see it's a little bit of a bullish candle. We're not closing. This, of course, we got 4 days left, but we're not closing yet up above last week's high. You obviously do not have a green arrow yet on the 10-week moving average. We have to get above it. The PPO is not rising yet either. It's still down 5%. And then your differential is positive. So you have one of the three things you like to see here on this chart. Likewise, on the whole, you can see we are bullish, a good bullish candle. We did not close up above yesterday's high point. And just to kind of give you an idea, tomorrow's daily Hakinyashi is going to open up probably about 38.61, and we're trading at 3900. So, we'll see. It's going to be a smaller body tomorrow. The MACD is already kind of rolling over a little bit without the histogram's already rolling over without the MACD even necessarily getting up above zero yet. The parabolic SAR did move down, so you finally have all three things: bullish, Hakinyashi, parabolic SAR, and a green line. But with the histogram already peaking, potentially at least, then that kind of goes to show that this might not last. Again, I don't expect a big downward move, probably not even that big, but we'll probably stay down in this area for a little bit of time. Let's look at some of the other oscillators. The DMI, again, when we're bullish, that negative indicator gets below 20 and the positive gets above 25. So something like that over here, and that just hasn't, and we're not even close to that happening yet. In fact, we're kind of more the opposite, where the positive is looking like it might hit some resistance here and roll over. And when we're bullish on the RSI and the CCI, we're going to be above 100, ideally above 150. We're going to be well above 60. So that's not the case, and either one of these are both kind of looking like they might be hitting some resistance levels too. You're looking at the trend strength indicator. We are not as strongly bearish anymore. We are at the blue line, which is the 26-day midpoint. And we're not to zero. You notice the lines dropped to very weak bearish patterns, very, very weak, but they're still bearish, right? They didn't drop to zero to where we'd be just noise. So that's kind of an interesting development there. And then your Bollinger bandwidth. I mentioned on Twitter today, for those who follow me on Twitter, if you don't follow me, make sure that you do. I'm at David Settle 42. I mentioned on Twitter today that the Bollinger bandwidth is at really, really high levels for the S&P. There's only been 2 other times that we've been this high on the bandwidth, and then volatility, so the VVIX, right, how volatile the VIX is, was really high both those times, well above 100, easily above 100. Right now, we are easily below 100, which kind of goes to show, I mean, as volatile as we are right now, with that bandwidth as high as it is, with the historical volatility on right here, with historical volatility as high as it is, above implied, with the VIX 3M as high as it is, practically at 30, almost above 30, really, really close to being, in fact, it was above 30 just a few days ago. So being as high as it is, this is a really, really high level. I mean, just for some context here, I'm going to go out to a weekly chart. We don't stay above these levels very long, unless we're in some drastic COVID situation. So for the VIX 3M to be as high as it is, and VVIX to be as low as it is, right? So this is the VVIX, dropping all the way back down to 87, it's the lowest close that we've seen in the past 2 years, right? We haven't been this low on VVIX since going into the COVID high point, that divergent high point. And you can see it again, last time we were this low, we were well into bullish territory down here, right? We were easily in bullish territory. We're not anywhere near bullish territory. We're still in bearish territory, even though we're not, strongly bearish. But it does go to show that, that the VVIX is setting up for a spike in volatility. I think with the VIX right now, the VIX is not very high right now, as you can see. It's just barely above this 95th percentile, and that's the neutral zone. So you're just barely above the neutral in the very low end of bearish territory for risk appetite. But it does appear that the VIX is setting up, volatility is setting up for a spike to the upside. So here you can see we're down to below the 50-day moving average. We're still right around the 17-week moving average. Obviously the range of volatility relatively low today, but if we end up, obviously we're still above the 200. If we end up with a spike in volatility very similar coming out of the end of the month, that was something else I tweeted. Again, for those who are following me there, there's a kind of a precedent here for the ends of the month, right? All the monthly chart on the S&P 500. You can see all these, look at all these lower shadows. 5 of the 6 months this year, we've had lower shadows, which means that at the end of the month, we rallied. That's the end of the month in January. That's the end of the month in February, that big 2 days right there. That's the end of the month in March. That's the end of the month in April. We tried to get, or May, excuse me, we tried to get a good strong move the end of April, but then we finished right at the low point right there. And then the beginning of May, we rallied. But end of the month, and then now the end of the month here in June, I mean, all of these end of the months were all peaks, and then we dropped on each one of these. So you can see we're kind of setting up for resistance to hold and into, with a rally into the end of the month, especially into the end of a quarter. And remember, March was the last time we rallied into the end of the month and an end of a quarter. And then look at the rally, we are actually well above the 50-day moving average, 30, 50. By the time we got to the end of the month, the 8 was above the 17. They were both above the 30 and the 50. That's not the case right now. We're still below the 30 and the 50. So a lot more bearish here, and again, setting up for that type of move like we had coming out of the end of the quarter in March, going into April expiration. You expect we'll probably get that kind of move, if not maybe slightly lower, going into a July expiration. Let's take a look at the intraday chart. First of all, let's look at the. We didn't look at the 3 green arrows. Again, you see all those layers of resistance here, and when you have a gap between these moving averages, remember you need to ideally cross above both. When you can get above both, then you can be bullish for a while. But here you're only crossing over the 17. We didn't get above both, and we're not anywhere near trying to get above both. Over here you got above the 30, but you couldn't get above the 30 and the 50, and so you traded in that gap. And right now it looks like we're just trading within resistance in that gap. So with volatility, looking like it's setting up for that move, like I said, with the VVIX setting up for a move, with the intraday chart kind of showing look at that range. Very, very small range at last week's high point, which happened to be at the very end of the week. We actually closed, but by the end of the day today, we closed below last week's high, which was Friday's high. And again, holding that gap, right? See, that's the important gap right here that we still haven't filled in. Breakthrough there, and we're going to be bullish up to 411. And to kind of give you an idea of how significant that would be, if we were to get up to 411, 411 is right there. So we would be above those 38% retracement levels. We'd be and above the 50-day moving average. So that would be a significant break. So either we break into that area and we're going to be pretty darn bullish, which is a possibility, or as you can see, it appears that the top of this gap is holding so far as resistance, and we come back again. There's not very much volume down below here because we moved up so fast, and we can work our way back down to 376, if not back down below that, and fill in this gap from down here, which you would consider to be fill in this gap first, and then this one over here, which you would consider to be a common gap. So that's the expectation. You can see when you're looking at the is it this one? No, when you're looking at the 3 green arrows, you can see we have 2 green arrows. The MACD histogram is rising, but not only did the range drop, but so did the volume. 66 million shares trading hands today. So again, not the best follow through type day. You would have liked to seen. I mean, 66 million is way down here. The ATR is still very high. You would expect the VIX to be a lot higher when the ATR is near 2.5%. The ATR here at 9 points, but again, relative to its price, very, very high. So with the VIX low and the VVIX especially low, it appears again that we are setting up for that type of move, that type of let's see if I were to go to here and then go to monthly and then go to the VVIX. So this would be the end of March, and then we had the rally coming out of the end of March. Let me show you what that looked like on a daily chart. So here was the end of March on the VVIX. When the VIX kind of got to a low, the market peaked right there at the very end of the month. You can see we had a little bit of a rally coming into April expiration. In the VIX, you see also there was the end of March right there, and then you can see the rally we had going into basically the beginning of May. So we're a lot, even though the VVIX is a lot lower now than it was then, the VIX is a lot higher now than it was then, and that's the type of move you expect. And that's what we got out of it then, with the VVIX really not jumping very much. It really wasn't that low, and it didn't jump that much, but you saw how much the VIX rallied. The VVIX is lower now than then, and the VIX is at a, which means, again, we can get a bigger spike, and the VIX is already at a higher level now than it was then. So we might get, you know, this kind of move up to the 105 to 115% on this next layer higher. And I'm expecting coming out of July, probably after the holiday, because it's typically bullish going into the holiday, but probably after the holiday, I'm expecting that we will go into July expiration more on a down note. Definitely could be wrong on that, because that's definitely a very, very short-term prognostication, but that's kind of what I'm expecting based on what I'm seeing here. What do you think? Do you agree with that? Do you disagree? Let me know in the comments section below, especially if you disagree. What charts or indicators are you looking at that tell you that you're either a lot more bearish than that, or you're a lot more bullish than I am? All right, now let's take a look at what's driving this action. Let's just look at today alone. So give me 1 second to get to June. There we go. You can see that everything was relatively flat. The only real big downside movers were the Qs on one hand, and IWM was actually up today, almost 0.5%. The Qs were down nearly 1%. And then TLT, you can see long-term bonds. Let's take a look at long-term bonds. They've been continuing to decline, which means the yields have been rising, right? Yields back up above that 8-day moving average, 3.2%. You can see the histogram is turning up. We'll see if that MACD turns up too. Could that lead to some more bearishness on bonds? You'd expect some peak there if that's the case. Interestingly enough, bonds and stocks have been positively correlated this year for the most part. If I would put on the correlation here and put on, there we go, and put this on to like the last quarter, put it to the ETF, just like TLT. And you can see down here about 90% positively correlated right now. So when bonds and stocks move in the same direction, not very common for that to happen. Here, let me get rid of these other indicators so we can see it a little bit better. There we go. It's not very common for them to be moving together, pretty much hand in hand. You can see it can, but it doesn't last very long. It goes up and goes right back down, up and right back down. So, if I were to draw a line here, oops, sorry. If I were to draw a line here and just put it at 0, then you can see generally it spends more time below 0 than it does above 0. You can see the big dips and how long it stays there until this past year or so. Then you can see it's actually been pretty bullish. So yields fell, bonds rallied, and so did stocks going into the end of the year. But now they've been positively correlated, but to the downside. While bonds have been in this downward decline here. Let me put it on a weekly chart. And then I'll put that correlation let's keep it on the quarterly basis here. Well, you can even see like there, if I were to keep the same 63 period, again, it's not very common, but you can see how, they both fell, and bonds are in a bear market, and they're falling at the same time as stocks are. So, you would expect that would bring bonds falling back down, would also bring equities back down. Here, let me get to Bitcoin. Let's take a look at Bitcoin here. It's back below 21,000. I have a little bit of a down day today. It's been trading right around the 8-week moving average. A little bit thrown off by this bad print. I don't know why. Thinkorswim's got that 0 print there. But again, back below these levels is a relatively bearish mark. I mean, that's where the 200-week moving average is. It's well below the 8-week moving average. So it's relatively bearish for Bitcoin to be, and again, getting below 20,000 will be very significant. I mean, getting below this 18,000, that's the last Fibonacci retracement area it's got left, would make a move down to 10,000 pretty darn feasible, which again would be a reflection of risk appetite on the far riskier scale. ARK Investments had a great week last week, and so far have been unable to follow through. And you can see we've had a good week or two previously. Earlier this year, and it didn't follow through very well, and the week after, even though it did go up another week after that, but didn't follow through that week very well. And you can see a couple of other periods, but at least that one your MACD got positive, and that looks to be the case again here. And we'll see what kind of follow through we end up getting. Again, ARK Investments, Bitcoin on that far end of the risk appetite scale. On the other end of the risk appetite scale is more of your diamonds, your Dow Jones Industrial Average, which came really close to its 200-week moving average and bounced off of it, still easily below. And then you have your dividend stocks, your dividend aristocrat type stocks, and you can see that again they're just 2 weeks ago. These dividend stocks, they had a couple really down weeks after holding up very well for most of the year. 2 weeks ago, they just started to correct, and now you're getting it's more of a pullback. Now you're kind of getting a failed pullback bounce, and then you'd expect that up towards these resistance levels, you'd expect that they would correct too down to that 200-week moving average, like they tend to do in other corrections. Even going, let's see how far back do we have? We do have that 2008. Even during that 2008 correction, dividend stocks were also correcting at that time, and then went into they actually were underperforming the broader market during most of that period. So they do correct, right? These stocks do correct, and they do correct. And so I do think that they will start to work their way down. They finally have joined the party, right? That last shoe has finally started to fall. And you see that in XLE as well, right? XLE has been doing really well too for most of this year. It finally broke its 17-week moving average 2 weeks ago. At the same time, those dividend stocks broke down below that 50. So these are kind of like the last shoes to fall on. I don't think this will get all the way to a 200-week, but getting to the 50-week would be a significant drop and kind of confirm the broader correction. And then it'll be a matter of whether the correction bounce will lead us up to new highs across the board. And of course, the likelihood of that happening is relatively low. Let's take a look at how the sectors are performing here today. So let's go to June. You can see the energy drop that we've seen over the last little bit. So because it's been so down, it bounced up the most today. So energy, utilities. I mean, this is not like high quality leadership here. I mean, that's typically it's XOK, XLC, XLY. Those are your biggest losers today. So I wouldn't put a lot of stock into this leadership. As to whether or not, again, if you go back just another 5 days, so you go to 1, 2, 3, 4, 5 days to see the rally that we had. I mean, those were the leaders during most of the rally, and they're starting to give back some of that. And then energy was a big loser, by far the biggest loser, and it bounced up. So you can kind of see, what was the biggest winners today and why. And I expect that will continue. I expect as we come out of the July 4th holiday, we might hold up here most of this week, but out of the holiday, we'll probably start to finally fall back down. We could fall back down going into the end of the week here, but probably will be next week when we'll get most of the more significant. It won't be. I think the days of us getting these big 3% drops are done. But if we're going to get anything more than 1%, I don't think that will happen until probably after the holiday next week. All right, let's take a look at our trade idea for today, and I wanted to take a look at Boeing. Boeing looks very similar to the broader market. It's hitting up against Fibonacci resistance. The intermediate line's actually gotten up here in the bullish levels, but you notice the near-term line's already forming the potential of a bearish divergence with higher highs and lower highs on the near-term line. If the intermediate line peaks here, and this is all we get, that's a pretty bearish peak. We are getting dark green shading the green line, though we are still near that 23% retracement. You notice easily still below the post-COVID rally 23% retracement level. Actually, excuse me, that would be, let me go back out. It'd be this decline. It's the COVID decline. So we're still below that high, as well as that 38% retracement of the current intermediate decline. So there's still some pretty decent resistance here in this area. If you take a look at some of the other oscillators for this chart, again, looking at the DMI, you can see, again, it's very similar to the S&P. This is the positive directional index looks like it's hitting resistance, with the negative still easily above 25. Looking at the RSI and the CCI, they also look like they're hitting up against resistance, looking like they're more likely to roll back over here. The Ichimoku cloud, we are further above the blue line than the S&P was, though we are still below the cloud, so there's still going to be some resistance there in that area. And then the Bollinger Band, that upper quartile, the bottom of that upper quartile, also acting as resistance, as it has done in the past. So there's an opportunity for us to kind of roll over here with the market kind of, looking like it's kind of, not really getting the strongest bullishness, and more likely going to trade within the range that we set over the last little bit. So what I decided to do on this was to look at it, just do a bear call spread. We're going to do a bear call spread for August expiration, just your typical normal bear call spread. But here's something to consider. You can see there's very little volume above us. So if this breaks above the 50-day moving average, which is kind of acting as a resort right now, resistance, if it breaks above that, it can really shoot to the upside. There is nothing holding it back. So what we decided to do then to protect against that was to do a really low cost protection, do a long call spread for just 84 bucks that gives us a potential $400 reward, because if we do take off to the upside, we're going to be willing to lose 360 bucks on this trade. That's what we're trying to make. So I can cover the whole loss on that with a very small trade. If we go down, I'll probably end up losing 20-30 bucks if we do hold this resistance and go down to the downside. So I can probably, I'm going to be giving up 20-30 bucks, maybe up to 40 bucks of my maximum gain to be able to pretty much more than protect all of my maximum loss on this trade. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up a new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Remember to hit that like button, hit that thumbs up button on our YouTube channel. Subscribe to our YouTube channel. Comment on the video. Subscribe to us at MarketScholars.com. Like us on Twitter and Facebook. Have a great rest of your Monday night, everybody, and we'll see you all next time.